Today we're doing a complete breakdown of IAS 21. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying international financial reporting standards, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before IAS 21, companies struggled with chaotic foreign exchange impacts, distorting their financial results. Imagine a multinational reporting millions in volatile exchange rate effects. With IAS 21, businesses now translate foreign operations consistently, reflecting clearer financial pictures. You'll grasp how this standard transforms unpredictable currency swings into comprehensible financial data. IAS 21 emerged to tackle the inconsistencies in handling foreign currencies, which were wreaking havoc on financial statements. Companies reported millions in exchange differences without clarity. With IAS 21, there's a structured method to translate and consolidate foreign currency transactions, ensuring more reliable financial reporting. This clarity aids investors and analysts in making informed decisions without drowning in currency chaos. IAS 21 is a must for any entity engaging in international trade or investments. Effective from January 1, 1995, it mandates translating foreign currency transactions into the entity's functional currency. The standard requires recognizing exchange differences in profit or loss, ensuring transparency. This approach aids in presenting financial results that truly reflect economic realities, pivotal for entities with global operations. The foreign currency translation model is central to IAS 21, making it essential for job interviews. This model translates foreign transactions into functional currency using exchange rates. Monetary items use closing rates, while non-monetary items rely on historical rates. Such precision ensures financial statements reflect actual economic conditions, providing true insights into financial health. Mastering this concept can set you apart in finance roles. Scope clarity matters. It ensures accurate application, avoiding costly errors. Candidates often forget that transactions involving non-monetary items aren't covered by IAS 21, leading to common interview pitfalls. Understanding these distinctions can differentiate you as a candidate who truly gets the nuances of international financial reporting standards. IAS 21 applies to foreign currency transactions, ensuring accuracy in how businesses recognize foreign sales and expenses. Also, translation of foreign operations is crucial for consolidating global subsidiaries. Exchange differences from monetary items like loans can impact profit or loss, affecting financial statements significantly. Accurately translating foreign branches' results ensures reliability in a multinational's consolidated accounts. Understanding exclusions is key. Transactions involving non-monetary items like inventory do not affect exchange differences. Hedging transactions fall outside IAS 21, governed by International Financial Reporting Standards 9. Items valued at fair value in foreign currency are excluded, since their valuation differences stem from market changes, not currency fluctuations. Intercompany transactions that don't create monetary assets or liabilities also lie outside the scope, focusing on genuine monetary exchanges. Functional currency represents the core currency of an entity's primary economic environment. For instance, a UK company exporting primarily to the EU may have its functional currency as EEUR. This decision impacts how transactions are recorded and reported. Changing functional currency isn't taken lightly. It requires substantial economic shifts, such as significant change in customer base. Correctly identifying this currency ensures financial statements reflect true economic activities. Choosing a presentation currency allows companies to align financials with stakeholder expectations. For instance, a European firm reporting in USD to cater to global investors. Changing this requires a comprehensive restatement of prior financials, as if the new currency was always in use. Although functional and presentation currencies can differ, consistency in reporting ensures clarity for users, maintaining transparency and comparability in financial disclosures. Navigating edge cases requires precision. Translating a foreign subsidiary's financials for consolidation is covered under IAS 21. However, currency swaps fall under International Financial Reporting Standards 9 due to their nature as financial instruments. Exchange differences from non-monetary items like inventory are not recognized under this standard. Yet foreign currency loans are included, with their exchange differences impacting profit or loss, highlighting the standard's focus on monetary items. Imagine running a multinational corporation where contracts span various currencies. IAS 21's foreign currency translation model is crucial for accurately reflecting these transactions in financial statements. Without it, currency fluctuations could obscure true financial performance, leading to misinformed decisions. Understanding this model ensures transparent, comparable, and consistent financial reporting across borders. The foreign currency translation model translates foreign operations to a consistent currency, ensuring financial clarity. Our example features Meridian Corporation's $10 million SaaS contract. This journey will demonstrate how each transaction is translated and consolidated, reflecting the business's true value. Understanding this model is key to managing foreign exchange risks, ensuring accuracy in global financial reporting. Meridian Corporation must first identify its functional currency, defined by the primary economic environment for its operations. With its $10 million SaaS contract, Meridian's revenue and costs predominantly arise from USD transactions, making USD its functional currency. Common errors include confusing functional with presentation currency, leading to misaligned financials. Following this step ensures subsequent translations reflect true economic conditions. With USD as Meridian Corporation's functional currency, translating each foreign transaction at the spot rate on the transaction date is crucial. For their $10 million SaaS contract, initial entries are converted using spot rates, preventing valuation errors. A frequent pitfall is applying average rates, which may skew financial results. Ensuring accurate spot rate application sets the foundation for the next step. Exchange differences in Meridian Corporation's $10 million SaaS contract arise from revaluation of outstanding balances at period-end rates. These differences affect profit or other comprehensive income, OCI. The error often lies in misclassifying exchange differences, impacting financial outcomes. Proper recognition is vital, as monetary item differences typically hit profit, unless qualifying for OCI. This precise recognition influences the subsequent translation of foreign operations financial statements. Meridian Corporation must translate its foreign subsidiaries' financials to USD, the presentation currency, using closing rates for assets and liabilities. Income and expenses are converted using transaction or average rates. A common misstep is neglecting cumulative exchange differences, skewing retained earnings. By accurately translating these financials, Meridian prepares for the final consolidation, ensuring its global financial picture is clear and consistent. Finally, Meridian Corporation consolidates its translated financials, including those from its $10 million SaaS contract, into a comprehensive USD statement. This process involves eliminating intra-group transactions to avoid inflated figures. A frequent error is overlooking these eliminations, leading to misrepresented financials. Successful consolidation delivers a cohesive financial picture, ensuring that Meridian's global operations reflect true performance and financial position across borders. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. IAS 21 requires careful consideration of exchange rates, influencing both initial recognition and ongoing measurement. Disclosures ensure investors understand currency impacts, crucial for global firms with diverse operations. When you're dealing with foreign currency transactions, IAS 21 mandates initial recognition at the spot exchange rate on the transaction date. This ensures accuracy right from the start. For a company engaging in international trade, recognizing a $1 million import at the correct rate can affect margins significantly. Monetary assets are reevaluated using closing rates, keeping balance sheets reflective of current conditions. Subsequent measurement under IAS 21 involves re-evaluating monetary items using the closing exchange rate at each reporting date. This remeasurement is crucial. Imagine a $10 million receivable. A 10% currency depreciation could result in a significant loss, impacting the profit and loss. Non-monetary items, however, stay at historical rates, ensuring stability in asset valuation. Analyzing exchange rate impacts is key for accurate financial reporting. In financial statements, foreign exchange gains and losses directly impact your profit and loss, influencing overall financial performance. For instance, a $5 million foreign currency loss can significantly affect net income. Currency translation differences from subsidiaries are shown in OCI, highlighting group-wide exposure. On the balance sheet, monetary items reflect closing rates, ensuring current valuation. Comprehensive note disclosures are essential for understanding currency risk and strategic financial decisions. IAS 21 mandates key disclosures that enhance transparency. For instance, detailing exchange rates used helps stakeholders understand the basis of conversion. Reconciliation of translation differences in OCI offers insights into group currency exposure. The nature and amount of exchange differences in profit and loss are vital for assessing financial performance. Moreover, disclosing the impact on monetary items aids risk analysis, ensuring investors know how fluctuations affect financial health. Imagine a CFO managing a $5 million foreign transaction. Selecting the correct exchange rate is crucial. Incorrect valuation can distort financial results. Monthly remeasurements might lead to a $1 million impact on profit and loss, underscoring the importance of precise rate application. Clear disclosure of a $500,000 exchange loss ensures stakeholders fully grasp currency risk implications. Effective currency management can protect against volatility, maintaining consistent financial performance. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Every aspect, from initial recognition to eventual derecognition, unfolds under the guidance of IAS 21. The initial recognition of the operating lease at the spot exchange rate is crucial for Meridian Corporation's financials. IAS 21 requires translating foreign currency transactions at the exchange rate on the transaction date. This establishes the lease liability and right-of-use asset, initially recognized in the balance sheet, providing a foundational basis for future adjustments. Each monthly lease payment requires Meridian Corporation to adjust both cash and lease liability. IAS 21 mandates that such payments, initially in SGD, be translated using the exchange rate at payment date, affecting cash flows and reducing liabilities. This process reflects real-time currency exposure on Meridian's financials. Quarterly adjustments for currency fluctuations are essential under IAS 21. Meridian Corporation must recognize a foreign exchange loss to adjust lease liability to current rates. This approach captures exchange rate volatility, impacting profit and loss, and ensuring liabilities remain relevant and accurate. Translating balance sheet items at year-end is a hallmark of IAS 2021 compliance. Meridian Corporation must reflect all foreign currency items at the closing rate, impacting both equity and retained earnings. These adjustments ensure that financial statements accurately represent the entity's financial position in USD. Lease modifications driven by currency shifts require careful accounting treatment. By realigning liability and asset values to new contractual terms, Meridian Corporation maintains accuracy in financial reporting. IAS 21 ensures that such modifications are reflected transparently, sustaining financial statement integrity. Adjusting the currency translation reserve at year-end captures cumulative foreign exchange differences as per IAS 21. For Meridian Corporation, a $10,000 adjustment reconciles the reserve with actual currency movements, ensuring comprehensive and precise financial reporting. At lease termination, derecognition of liabilities and assets is crucial. Meridian Corporation's final settlement clears the balances, concluding the lease life cycle under IAS 21. This ensures no residual balances remain, maintaining financial statement accuracy and closing the accounting chapter on this lease. Final adjustments for foreign currency gains or losses wrap up the lease cycle. Meridian Corporation's $15,000 exchange gain reflects the net impact over the lease duration. This step finalizes exposure accounting, locking in the accurate representation of financial outcomes per IAS 21. Every Big Four and investment bank interview on IAS 21 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. IAS 21 deals with the effects of changes in foreign exchange rates. It ensures that financial statements reflect currency translations consistently. This standard prevents misleading information about a company's financial health due to currency fluctuations. Remember, the key is differentiating between functional and presentation currency to avoid common pitfalls. The functional currency is the primary economic environment in which a company operates, while the presentation currency is what financial statements are displayed in. Mistaking these can lead to incorrect financial reporting. Companies often operate in one currency but report in another, so clarity here is crucial. Exchange differences arise when translating monetary items at closing rates. They should be recognized in profit or loss in the period they occur. A common mistake is delaying recognition, skewing financial results. Consistent recognition ensures accurate reflection of financial performance. Non-monetary items are translated using the exchange rate at the date of the transaction. This excludes them from subsequent changes in exchange rates. Misapplying this can distort asset values. Remember, historical cost items use transaction date rates, ensuring stability in financial reporting. While both standards aim for consistency in foreign currency translation, Indian accounting standard may differ in specific guidance or emphasis. Recognize these subtle differences to ensure compliance with each jurisdiction's rules. This understanding prevents reporting errors when operating internationally. Always tailor your approach to jurisdiction-specific requirements. Foreign operations financials are translated using the closing rate method. Assets and liabilities use closing rates, while income and expenses use average rates. Avoid mixing methods. It leads to inconsistencies. Consistency aligns translation with economic reality, ensuring truthful representation of financials. Calculate exchange gains or losses by comparing transaction rates with closing rates. For example, if an invoice is issued at 1.2 USD per euro but settled at 1.3, the gain or loss reflects this difference. Misunderstanding this can distort financial results. Precision in rates ensures accurate profit or loss statements. During consolidation, exchange differences from translating foreign operations go to equity in a translation reserve. Repatriating these into profit loss on disposal requires careful handling. Misplacing these adjustments can misstate equity. Always segregate these differences to maintain accurate consolidated financial statements. IAS 21 excludes derivatives and certain hedge accounting. This trap catches many, as misunderstanding leads to incorrect application of exchange rate impacts. Knowing the scope ensures accurate application and prevents errors. Always verify if an item falls under IAS 21 or another standard like International Financial Reporting Standards 9. IAS 21 mandates disclosing the amount of exchange differences recognized in profit or loss and in equity. Detail is key to providing transparency on financial impacts. Omitting this can mislead stakeholders. Ensure comprehensive disclosures to reflect the full financial picture, supporting informed decision-making. IAS 21 sets the ground rules for how foreign currency transactions and operations are reflected in financial statements. It guides on recognition, measurement, and disclosure, focusing on functional currency, the main economic environment of an entity. Understanding key definitions like exchange rates and monetary items is crucial. This standard ensures clarity and consistency in handling foreign exchange impacts on international business. Foreign currency transactions demand meticulous treatment under IAS 21. Start with recording in the functional currency using the spot exchange rate. Monetary items are measured at the closing rate, with non-monetary at historical rates. Exchange differences typically hit profit or loss, barring net investments in foreign operations. Translating foreign operations involves a closing rate for balance sheets. Income statements use average rates, ensuring consistency across periods. Navigating IAS 21 during interviews. Steer clear of confusing functional and reporting currencies. Understand international financial reporting standards and U.S. generally accepted accounting principles differences, especially in translation adjustments. Key disclosures include showing exchange differences in profit or loss. Remember, changes in functional currency require prospective treatment. Translation reserves accumulate in other comprehensive income. only realized upon disposal of foreign operations. Stay sharp on these essentials to impress in interviews. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.